Hey traders, and welcome to the latest episode of 2.0 Trade Info. Today we're unlocking the secrets of a high-probability pin bar trading strategy. Trading without the ability to identify a quality pin bar can be extremely risky and could lead to significant losses. Many traders struggle with pin bars because they can appear anywhere in the market, and not all of them are worth trading. In this advanced episode, we'll focus on how to pinpoint the most powerful pin bar patterns and provide you with a detailed, step-by-step guide. We'll dive into the essentials of pin bars, explore the psychology driving them, discuss ideal setups in trending markets, and reveal the Confluence strategies that can boost your success. You'll also learn precise entry and exit techniques, along with the best time frames to maximize your win rate. Everything we discuss in this video can be used for stock trading, forex, and crypto because price action stays relatively consistent across different assets. If that's something you're interested in, make sure to hit the like button, share, subscribe if you're new. And don't forget to turn on the notification bell so that you don't miss out on new contents on financial markets. See you after intro. Welcome back, traders. Let's dive straight into the essentials of the pin bar. A pin bar is a standout candlestick pattern, easily recognized by its long tail, which signals strong rejection of a price level and suggests a potential reversal in market direction. The small area between the open and close, known as the real body, is typically minimal, while the long wick dominates, highlighting the price rejection. This unique structure makes the pin bar a powerful tool for spotting potential turning points in the market. A bullish pin bar features a small body with a long lower wick, signaling that buyers have rejected lower prices and are pushing the market upward. In contrast, a bearish pin bar has a small body and a long upper wick, indicating that sellers have rejected higher prices and are driving the market downward. The key to both pin bars is the ratio of the wick to the body. The wick should be at least twice the length of the body, if not more. The longer the wick, the stronger the signal. While the color of the candlestick is less important, bullish candles with green bodies generally offer stronger signals than those with red bodies. The pin bar pattern provides deep insight into market sentiment. Just as navigating unfamiliar terrain is difficult without understanding the language, success in trading requires fluency in reading candlestick patterns, which is the language of the market. So, mastering the psychology behind candlestick patterns allows traders to interpret the underlying market forces and gain a strategic advantage. Now let's dive into the psychology of the pin bar. This distinctive candlestick pattern is easily recognized by its small body and long tail, signaling a rejection of key price levels and hinting at an impending market reversal. The psychology behind the pin bar is rooted in the battle between buyers and sellers during its formation. A bullish pin bar unfolds as sellers initially push the market lower after the open. However, buyers step in at a key level, rejecting the lower price and driving the market higher, eventually closing above the open with a small body. The long wick represents the intense buying pressure overpowering the sellers, making the bullish pin bar a strong reversal signal. In contrast, a bearish pin bar forms when the market trends upward, only for sellers to overwhelm buyers, rejecting higher prices and leaving a long upper wick, signaling a potential downward move. This long wick signifies strong selling pressure outweighing buying efforts, making the bearish pin bar a potential reversal signal. The pin bar reflects the struggle between opposing market forces, one side attempting to push the market in a direction, only to be overpowered by the other, resulting in a reversal. By understanding this underlying psychology, traders gain valuable insight into potential market turning points, making the pin bar a powerful tool in any trading strategy. Let's clarify the concept of a pin bar using a sharp, detailed example on a 15-minute chart that represents a one-week pin bar candle. This is the open of the pin bar. As soon as the market opens, sellers immediately step in, applying pressure at various price levels, determined to push the market down. The chart forms a descending triangle, which is a bearish continuation pattern that highlights increasing selling pressure. As the price breaks through the key support level, it signals the seller's dominance in the market. A substantial accumulation of orders follows, triggering a sharp move that breaks the structure and creates an inefficiency, leaving significant unfilled orders and a well-defined order block zone. This break further confirms the strength of the selling pressure. As we can see in the chart, a bullish pin bar forms, followed by a brief retracement. With sellers in control, they drive the price lower, breaking the structure, which is an additional signal of strong selling potential. This is the demand zone, signaling high reversal potential. Buyers swiftly reject the downward momentum by forming a bullish engulfing candlestick, which is a powerful reversal signal. This pattern indicates the market is preparing to reverse, driven by strong buying pressure. As the market pushes higher and breaks the previous lower high, it confirms a trend shift and a clear change in character, signaling the potential start of a new uptrend. After a brief pullback, renewed buying pressure drives the price higher, forming a new higher high. The previous resistance level is now acting as support, with the price respecting this zone, indicating the market's recognition of its importance. The buying momentum persists, propelling the market upward. Eventually, the price experiences an impulsive move and closes just below its opening level, forming a pin bar. Understanding the psychology behind the pin bar is essential, but it's just one piece of the puzzle. To succeed, you need to combine it with other factors to build powerful trading setups. To leverage the pin bar pattern for high-probability trades, you need to follow three essential criteria. First, the market trend, next is the key levels, and the third is the 21 moving average. So let's start with the trend. To set up high-quality trades, it's crucial to first identify the market's prevailing trend. By understanding whether the market is in an uptrend or downtrend, we can accurately assess which group is in control. In an uptrend, buyers dominate the market, pushing prices higher. Conversely, in a downtrend, sellers have the upper hand, driving prices downward. A pin bar is a candlestick formation that signals a potential price reversal, and its effectiveness heavily depends on its alignment with the market trend. A pin bar formed in the direction of the trend is significantly more powerful than one formed against it. For instance, in an uptrend, a bullish pin bar that signals a continuation of buying pressure is more likely to succeed. In a downtrend, a bearish pin bar signaling continued selling has a higher chance of being effective. Why pin bars aligned with the trend are effective? The reason for this lies in the momentum and market control. When a pin bar forms with the trend, it aligns with the dominant market force, whether buyers in an uptrend or sellers in a downtrend. This increases the likelihood of success since the market's momentum supports the pin bar's direction. Conversely, a pin bar against the trend struggles because it conflicts with the stronger market force. For example, in an uptrend, a bearish pin bar would signal selling, but with buyers in control, such a signal is often weak and unreliable. Let's visualize this with an example. In the chart, the market is in a clear uptrend, meaning buyers are in control. These bearish pin bars formed against the trend fail to reverse the market because the overall buying pressure is too strong. Therefore, these bearish signals are ineffective and should be ignored. On the other hand, the bullish pin bars formed in line with the trend reinforce the buying momentum. These signals work well and thus should be considered for trades. Pin bars that align with the market's trend are significantly more effective, providing clearer, stronger trade signals. Always ensure that the pin bar is in the direction of the market trend to maximize the probability of a successful trade. Let's move forward with the next setup. After identifying the market trend, the next critical step is to wait for pin bars to form at significant key levels, specifically support and resistance levels. These levels are crucial because they represent areas where price action is likely to reverse or continue with the trend. A pin bar formed at these levels provides a strong signal of market direction. Imagine we have a structure like this. As we can see in here, the price breaks previous higher high, resulting a break of structure and make an impulsive move. Now this resistance level becomes a support level after a pullback. So this transition creates an important zone for potential trade setups. When a pin bar forms at this new support level, it signals that the market has the potential to move in the direction of the trend. The pin bar represents a rejection of lower prices, showing that buyers are stepping in to maintain control, reinforcing the uptrend. In another case, We see the market consolidate around a support level without breaking it. After breaking through a significant resistance level, the price makes an impulsive move upwards. The pullback to the resistance level becomes a key area to watch. If a bullish pin bar is formed at this level, then it signals that the market is ready for another impulsive move, creating a high probability trade setup. When pin bars form at these major support levels during a trending market, they provide valuable insight into market behavior. Pin bars indicate price rejection at these levels, and while rejection often suggests a reversal, when formed in the direction of the trend, it signals that the market will likely continue moving in that direction. As we can see in the chart, the market is in a clear uptrend. A bullish pin bar forms at this support level after a pullback. The buying pressure behind this pin bar aligns with the trend, suggesting that the market will continue upward. This creates a strong signal for a long position. Conversely, a bearish pin bar formed against the trend is invalid, because sellers failed to break the support level. The presence of this support level and the resulting price rejection signal that buying pressure remains in control, keeping the uptrend intact. As we can see on the chart, the market presents two strong opportunities for long positions. First, there is an aggressive buying move that leaves behind unfilled orders, creating a crucial order block area. This zone becomes a key entry point. Once the price retraces and taps into this OB zone, you can enter long, placing your stop loss just below it. We'll dive deeper into the order block concept and its strategy in the next episode, so stay tuned. The market provides another entry setup. Notice the pin bar forming at this support level during the uptrend. This is a powerful continuation signal, offering a high probability trade with a favorable risk-reward ratio. Enter long here with a well-placed stop loss. By focusing on trend-aligned pin bars at major key levels, traders can identify high-probability setups with clear signals of where the market is likely headed. So, let's move forward with the last one to make this setup stronger. In a trending market, it's not always possible to clearly define support and resistance levels due to the way prices move. This can result in missed trading opportunities. To avoid this, we highly recommend you to use 21-period moving average, as it acts as dynamic support in an uptrend and dynamic resistance in a downtrend, offering an additional layer of confidence when trading pin bars. The 21-period moving average offers a reliable and adaptable guide for traders, especially when price action doesn't clearly align with typical support or resistance levels. In the chart, the market is in a downtrend, and a bearish pin bar forms in line with the trend. The 21 moving average acts as dynamic resistance, and although the price briefly crosses above the moving average, the buying pressure is rejected. Selling pressure dominates, confirming the downtrend and preventing the market from reversing direction. This rejection at the moving average is a clear signal to enter a short position, as the market is likely to continue downward. The 21 moving average acts as a dynamic support in uptrends and dynamic resistance in downtrends. Rejections at the moving average, combined with pin bar formations in the direction of the trend, provide high-confidence trade setups. By using the moving average in this way, you can confidently enter trades, avoid missed opportunities, and capture the momentum of the trend. By ensuring these three elements align, identifying the trend, confirming the pin bar's location at key levels, and validating with the 21 moving average, you can significantly increase the probability of a successful trade. Now let's dive into the next topic of this video, the Confluence setup. Confluence happens when multiple indicators point to the same signal, and it's a go-to strategy for price action traders to filter entries and find high-probability trades. Whether you're a beginner or an experienced trader, trading with Confluence helps you focus on quality setups and can really improve your results. In this setup, we'll use the key elements from the pin bar setup: market trend, key levels, and the 21 moving average. Plus, we'll add one more factor to boost your chances of success: the Fibonacci retracement tool. The Fibonacci retracement tool is one of the most powerful tools in technical analysis, used to identify potential reversal points in a trending market. The key idea is that after a significant price move, markets often retrace to certain predictable levels before continuing in the original direction. The 50% level is often a key area where reversals happen. If price rejects from this level in the direction of the original trend, it's a strong signal for entry. Let's see how the pin bar works with the Fibonacci tool on this 4-hour Euro versus British pound chart. As we can see in the chart, the price has experienced a sharp and substantial move, breaking the previous higher low, confirming a change in character. This indicates a potential trend shift, signaling a new downtrend is likely emerging. The price breaks below the support level but retraces back, forming a pin bar, which flips the support into resistance. This pin bar at resistance suggests the retracement is over, and an impulsive move is likely next. By applying the 21 moving average and Fibonacci retracement, we can see the pin bar is rejected from both levels, highlighting the significance of this area and showing that sellers are stepping in to push the market lower. The pin bar's rejection from the 50% Fibonacci retracement level confirms the entry. You can confidently open a short position by applying a proper stop loss. So, aligning these factors can significantly boost your win rate in trading. Now we will see which time frame works best for the pin bar trading strategy. When trading pin bars, selecting the right time frame is crucial for effectiveness. Here's an overview of the recommended time frames for pin bar setups. The daily time frame is ideal for identifying strong, reliable pin bars because it filters out market noise and gives a clear picture of the overall trend. Pin bars formed on the daily chart tend to have higher accuracy and provide more reliable signals. The 4-hour is also a popular time frame for pin bar trading. It strikes a balance between capturing sufficient market activity and avoiding the noise of lower time frames. A pin bar on the 4-hour chart is often a strong indication of price rejection at key levels. Pin bars on higher time frames like the daily and 4-hour are less prone to false signals and reflect the market's true direction. They also allow for better risk-reward ratios due to clearer trends. The 1-hour chart is also commonly used for pin bar setups, especially for traders who want more frequent opportunities while still maintaining relatively reliable signals. Pin bars on the 1-hour chart can be effective, especially when combined with higher time frame trends. It gives more opportunities for trading pin bars while still avoiding much of the volatility found in very short-term time frames. We do not recommend 15-minute and 5-minute charts for pin bar setups, as they can lead to false signals due to market noise. These time frames are typically used by scalpers or traders looking for quick, short-term trades. Pin bars formed on these charts are often less reliable and more prone to being invalidated by sudden market fluctuations. However, if a pin bar on the 15-minute chart meets all the setup criteria, it can still be a valid entry signal, but it's important to fully understand the risk involved. Let's move on to the final topic of this video, the entry and exit strategy. We will discuss two primary approaches to entering and exiting trades: aggressive entry and conservative entry. So let's begin with the aggressive entry. Sometimes the price moves quickly right after the close of a pin bar candlestick, and you might miss the trade. To prevent this, enter the market immediately after the pin bar closes. For a bearish pin bar in a downtrend, place your stop loss just above the wick when selling, targeting the next demand zone. Conversely, for a bullish pin bar in an uptrend, set your stop loss just below the wick and target the next supply zone. Conservative entry strategy involves entering at the 50% level of the pin bar. This means placing your order halfway between the high and low of the pin bar's wick. Set your stop loss just beyond the pin bar. This provides a better risk-reward ratio than entering at the break of the pin bar, which is typical in aggressive strategies. For a bearish pin bar, place the stop loss above the high of the pin bar. For a bullish pin bar, set the stop loss below the low, and the targets can be the same as those used in the aggressive entry strategy. Or you can set a 1-to-2 or 1-to-3 risk-reward ratio. This strategy allows you to enter at a better price, reducing your risk while still aiming for profitable targets. Before entering a trade with pin bars, ensure the pin bar meets all criteria in the setup. Now let's examine an example on the real chart. In the chart, we observe a bearish pin bar forming at the resistance level, which meets the criteria for the Confluence setup. This indicates a strong potential for a downward movement. You can confidently enter a short position right after the pin bar closes. To manage risk effectively, place your stop loss just above the wick of the pin bar, with the target set at the next demand zone. Let's analyze another real chart of the British pound to US dollar for a conservative entry point. Here we observe a pin bar formed at a resistance level, which meets the criteria for a confluence setup, indicating a potential short position. Notably, after the pin bar closes, the price retraces to the 50% level of the pin bar. This presents an ideal entry opportunity at that 50% mark. Set your stop loss just above the pin bar's wick, and target the next demand zone. Alternatively, you can establish a risk-reward ratio of 1:2 or 1:3 for this trade. By following these guidelines, you can enhance your trading strategy and improve your chances of success. An important point to remember is that the market doesn't always retrace to the 50% level of the range bar. Sometimes it may reach your profit target without your entry. However, both can be effective. With practice and screen time, you'll gain the experience necessary to determine when to trade aggressively or conservatively. That's it, traders. Thanks for watching. If you found this helpful, please hit the like button, subscribe if you are new, and turn on notifications for more updates. Drop your feedback, questions, or topic suggestions in the comments. Once again, thank you for your support and see you next time.